The only reason why I mentioned that is because I wanted a 90-10 policy. So a
Oh yeah,
90,
here we go. Yeah,
90,
yeah.
90% paid up addition and a 10% base policy. The longer I've researched and the more I understand, I would start panicking. I'd reach out to my advisor and I'd realize that I just mess up and then I'd find out that I ended up being a 60-40
Oh
policy,
no, oh no, oh no, disaster. All right.
which the long range part of that is that
He's just ripping you off, Glenn. That's the only reason he would do that.
I could tell you that the long range is I'm going to want to continue to fund the premium as long as I possibly can.
Exactly.
I heard on a podcast, but they were talking about the base being the funds that you're putting towards a long-term plan. Not that it's an investment, but
Right.
it's like
Right.
a retirement, like the money that I would be putting towards my retirement. Maybe I put it towards the base to start with. The financing of life would be the PUA stuff. So the PUA would be like my taxes that I have to pay every year, my insurance, maybe even CapEx. But maybe the
Yep.
CapEx to be part of the base because last month I spent $12,000 on a roof. Where would that go?
If you take someone through an educational process, I sometimes do with my clients, depending on how deep they want to go in case design, I will
Yeah.
show them extremes, not because I'm trying to throw different policies at them. I generally know what design is going to make sense for them, but so they can understand why we should want a higher base premium. If you look at an all base policy with a really good mutually held insurance carrier, the sort of policy that a lot of people like to make fun of, but I don't because I see the use case for them. I've never actually designed one of those for infinite banking. It generally, you'd add
Yeah.
the term rider and the paid up additions rider. But if you look at that in year 30 and compare it to an infinite banking style policy, you cannot tell the difference. You really cannot tell the difference because the base is what gives you the leverage over the long run.
Yeah.
You'll notice a massive difference in the first 5 years. That infinite banking style policy will be way ahead in terms of cash value. But over the long run, it's the base premium that drives the growth of the policy.
Yes.
That's really it. It's the foundation, just like any house. You must have the foundation. You may not see it. It's not something you look at and consciously think about, but without it, the whole structure collapses. Right.
Definitely.
We're getting into inside baseball around case design. You don't need to understand all of this. Just understand that in a whole life insurance policy, there are typically 3 different components. If it's an infinite banking style policy, there's the base premium, which is the foundation. There's the term rider, which is like scaffolding that temporarily allows you to build higher. And then there's the paid up additions rider, which is the actual brick and mortar above ground that you're going to see. And you need all 3. You cannot
Yeah.
isolate one of them. They all work together. That's important too. It's not like one is more important than the other. No, they all work together and you need all of them working together. And in those 1090 policies, it's interesting because 1090 is really more of a marketing term. It doesn't have a specific definition because even the phrase 1090 ignores probably the most important, most delicate part of that, which is the term rider. This is the thing everyone forgets. They talk about the base, they talk about the paid up additions, they forget about the term rider. That's really important. People forget about it because it's typically not a massive amount of money you're putting into it. But in those 1090 policies, if you're going to have a skinny little foundation and a huge structure on top of it, the only way that works is if you have this massive term rider of this scaffolding that holds it all together. And so what you end up with is the structure that kind of sways in the wind and is very delicate. And people who have those 1090 policies, what they end up finding out is how much premium they pay every year changes. Some years they might have to pay more because the dividend wasn't enough to cover the term rider cost. Some years they have to pay less in order to avoid having that policy become taxable. I'm getting into a lot of the weeds of case design, but the point is higher base premium is a more stable foundational policy. Even if some of those skinny base premiums might perform better in terms of cash value, which I don't think they will, but even if they do, you're building in more risk. It's a less stable foundation. So it's better to err on the side of having too large of a base premium. Worst case scenario means the cash value growth won't be quite as good as it could have been. So what? Nobody cares. Over 50 years, who cares? But if your policy becomes a mech a modified endowment contract, if it becomes taxable, which there is a risk of that in those smaller base premium policies, now you have a big problem. Plus, everything about those skinny base premium policies now becomes so much more important. So you're talking about the flexibility where you're paying the base premium. You might pay the paid up additions rider later or at a different cadence or something like that. All of that is fine, unless you have one of these skinny base premium policies where now it's super, super, super critical that you pay the full annual premium every single year, or else it could really collapse the policy. And you could end up with an all base policy. You could end up with a modified endowment contract. People who sell those 1090 policies will advertise that there's a lot of flexibility because look, you only have to pay this much into the base. This much you can pay at will. That's a half truth. The question then becomes, what if I don't pay that paid up addition rider 1 year? Then what happens? Oftentimes what happens is you permanently lose the ability to pay that paid up additions rider. Now all you have is an all base policy, the kind of policy these people love to make fun of. I probably shouldn't be going into all these technical details, but since Glenn brought it up, and since I think the people who listen to this podcast have a better understanding of the infinite banking concept, understand that those skinny base premium policies look good on paper. The numbers look good because there are a lot of assumptions that go into that, what we call an illustration, which is not an illustration, it's just numbers on a page. I know agents who have inherited from other agents 1090 policies. One of them I've had on my show. We didn't talk about that specifically, and he said it's been a nightmare. That was his word, nightmare. The policy is still in force, but it requires a lot of maintenance when it shouldn't. This should be a bedrock foundational asset. It shouldn't be the sort of thing where you have to finely tune it every single year.
Yeah.
So imagine you buy a policy like that, and then 2 years in, you get a letter from the insurance company saying, you owe us another $1,500. You're like, what? I paid the full premium. And then you have to go back to your agent, who probably won't pick up the phone when you call, and find out that, yeah, see, the dividend was being used to pay that term rider. And this year, the dividend didn't cover the cost of that term rider. So you need to now pay that out of pocket. Otherwise, there won't be enough death benefit to support the policy. And now it becomes a mech and it all becomes taxable. Right. So to summarize, I have no problem with those policy designs if you really understand what you bought, why you bought it, all the risks inherent in it. And if you're okay with all of that, then I'm fine with it too. But generally, I find that the customers who buy those kinds of policies, they're just being sold based on the numbers on the page, and they
Yeah.
don't really understand all the trade-offs that go with that. And it makes my job more difficult when I show a policy that doesn't look as good on paper and the customer doesn't really have the skill set to discern. And so they pick the one that looks better on paper, not understanding all the hidden pitfalls that are behind it. Right.
Definitely.
So your mother made you a loan. How do you plan to use your policies in the future? Are you going to use them to finance real estate? Are you just going to use them to finance your operations? Or what do you think is
Yeah,
going to happen
fine.
there?
We're 650. We just sold a property last week, which I was able to capitalize correctly. I think there's a point of enough. When you have enough, you don't need to stress yourself out. And I think the biggest thing is there's a clear path. So when you're buying real estate, there's a lot of uncertainty. If you talk to any operator, and if there's no uncertainty, probably not telling you the whole truth. Lots of sleepless nights and stuff like that. So I would say that, and there's a cost to that, and it's generally your health. So my plan is to maintain what I have, maybe pick up a property once in a while and grow my personal portfolio and try to live a good life. And I can see myself growing my policies over time. I already can see a few policies that I want to convert some of the term. I went for a walk this morning and I had some clarity to my mind. Maybe it's just because I got a big check deposited into my bank account, but I could tell you that there's a clear path to what we're doing. And if you just are able to recapture the interest that we pay in general, you're on a good path, is what I would say, because we're going to be earners. Anybody watching this is going to educate themselves to eventually have that they're going to be doing in the future. I'm not very good at just doing nothing, and I always have to do something. That's where I'm at. I can grow the portfolio at a healthy rate instead of doubling in size like I did in 2024. I have a lot of debt because I have investors. The debt could be through paying back equity investors or the return that they're looking for, or secondary lien debt that could easily be paid off. And I think if I paid that off as well, I would be in a very good position financially. I would be able to open up a lot more policies on top of that as well.
Yeah, the more capital you have, the more your banking system needs to expand. And it happens naturally, it happens organically,
Yes.
right? So if you receive a big check, the question is, where am I going to put that? I'd rather put it in my own private bank than into a commercial bank that either comes in the way of additional premium payment or repaying a policy loan. Or if you've run out of room and all your policy loans are paid off, your premiums are fully paid, then it's time to take out a new policy and put the money there. The nice thing is you don't have to plan in advance what you're going to use your banking system for. You know you're going to use it for something. And generally, you're going to be continuing to do what you're already doing with real estate and quietly building capital inside your policies. And you'll know when the right moment is to use it. It will be maybe some operational expenses or capex you're going to use it for, or some great deal comes along where you now have the capital. So you now call the shots and you can now capitalize on those investments. And when you have capital working for you 24/7 in your whole life insurance policies on a guaranteed tax-free basis, it gives you a lot more investor discipline. You don't feel the need to jump at every potential investment opportunity. You don't feel the stress of I need to put my money to work for you because you know it's working for you. And so you're going to be much more discriminating about what does a real investment look like for me? You'll behave more like the Warren Buffetts of the world who are happy to sit on the sidelines with cash and be patient until a real investment opportunity comes along. And what a real investment looks like is subjective to you. There is no good investment in the abstract. It's what works for you, what suits your investor DNA. For Glenn Yaney, it's mobile home parks, but it could be different for everybody.
I reflect on a few times whenever I came across deals that I said to myself, if I had the funds, I would buy this. I had more of a shotgun approach. I was putting all my money in a 401k. I was putting money into a HSA, an IRA, maxing them all out. And it was maxing out my wife's as well. There was one year she said she wanted to put 70% of her pay into a 401k. So she was really $0 on her paycheck because we were just putting away the whole thing. Meanwhile, she's working. She worked all the way till she was 8 months pregnant with the first baby. And I'm working nonstop, stressed out from my old 9 to 5. And the whole time I'm putting my money into a 401k and HSA, which I actually like HSA still. I max it out every year. That's just my preference. Long story short, I'm doing things that are not aligned with what I'm trying to do, which was become financially independent. I had talked to some financial advisors or life insurance agents that I mentioned the infinite banking concept in 2013-15 time. The first policy that was sent to me was a 12,000 premium. And I couldn't see past like why I would do that. But I could tell you that if I were had to have done that, I probably wouldn't have had the capital to do those smaller deals that would have gotten me out of my 9 to 5 wait. And then once I left my 9 to 5 to work for another company, and I don't think there's anything wrong having a regular W-2. I know some people that make a lot of money working for somebody else, which I'm actually okay with. It's just that mine was grinding like a ball and chain. And the second I got $100,000 put into my bank account from selling a property, my mind shift changed, and I immediately decided that I wasn't going to work there and figure
It's
it
all
out.
about liquidity. Wall Street wants us to be super focused on return on investment,
But it's
which
terrible.
encourages us to lock as much of our money up in their jail as possible and chase that return. Well, Warren Buffett doesn't do that. He sits on the sidelines with cash. Obviously, he of all people knows he could get a better return if he put his money in the market, but he understands the value of staying liquid. Liquidity is your massive returns in waiting. And it's not about return on investment, it's about cash flow. You're not buying these properties so you can turn around and sell them at a higher price. You're buying them for the income that you can get from them. And this is where the inflexibility, I would call it the stability of a whole life insurance policy, is a huge advantage. A lot of people like 401ks because they call it a forced savings account. Well, it is forced. I don't know if it's savings, but that's where whole life insurance can be helpful, where it forces you to pay yourself first. It forces you to save money in a good way, where you do give up some liquidity. Something has to give. You do pay some fees and give up some liquidity, of course. But over the long run, you gain a lot more liquidity. That cash value, I can borrow against it without interrupting my savings plan. And the fact that I have this premium due, a lot of my clients have told me they like that because it's forcing them to save. It works against Parkinson's law. Just the same way some people will have their paycheck split up, or they'll have a portion of it go into a savings account where they don't ever see it. As a result, they don't spend it because they never see it hit their checking account. Anything that hits their checking account, there's a risk of it escaping and being spent. If it goes into my whole life insurance policy first, then it cannot escape. And even if I do spend it by way of a policy loan, I didn't use my money. I used the insurance company's money. My cash value is still earning for me, all of it. And you're doing the same with your mom. What you're telling her is she's still liquid. You understand
Yeah.
that's really what people want. If they would stop following the programming, they might realize that liquidity is really important. It's something to consider with any investment. Even if you're trying to get an attractive rate of return, you still need to consider liquidity. How liquid is the investment? How liquid is that vehicle? And obviously, with retirement accounts, which I'm not against them, they can work in certain scenarios, sure. But I don't think people really consider how much the loss of liquidity hurts them in the long run. Because to your point, Glenn, now when a great deal comes along, you're not liquid and you cannot take advantage of it. So yeah, you're earning some returns in your retirement account, but what about that big return you missed out on because your money was locked in jail?
Also, just to add to it, this past year, I've had considerable cash flow. It's more cash flow than I ever thought I would have. 13,000
Congratulations.
a month currently is something I couldn't even conceive that I would have. I was at 18. I thought I would be at 18. It wasn't going to go down. It came down to 13. I can see it going up in the near future. But the warm blanket at night is that cash reserve to stabilize myself, because it's really not the investment vehicle that's going to get me out of my 9 to 5. It's the warm blanket that I have that I know I could leave. Because
Yep.
I left one time, I left my 9 to 5 to go try to go into sales with real estate. And I think I had 30,000 in my bank account. I thought, if I have 30,000, I can last for 6 months. And I think at that point, my expenses were nothing. I probably could have lasted a year. But the fact is that $30,000 wasn't enough for me to sleep well at night. I left my job and I was stressed out because I wasn't getting a paycheck. I didn't know when I was going to get paid again because of the sales position. It made me go back to my old 9 to 5 because I didn't have enough reserves, but also didn't have a clear, direct path of cash flow. Really. So I had to create that, and I wasn't going to get that in a 401k.
Cash
I had
flow.
one.
It's just like Robert Kiyosaki says, it's all about cash flow. And I like how you keep using that word.
Yeah.
Reaching financial independence is not about building up some magic number in a nest egg, whatever you think that number is. Nobody knows because we don't know what the future is going to be. It's more about cash flow. Once I have enough cash flow where I can live off of that cash flow in terms of safe, reliable, passive income, passive, of course, but the more I then become independent because you don't spend return on investment, you spend income. People who have built up large nest eggs are still oftentimes nervous about retirement because they don't know how long that nest egg is going to last. What matters is not how large is your nest egg, but how much income can you generate from it. It's great if you have a lot of money stacked up somewhere, but it only benefits you based on how much income you can generate from it. And if the only way you can generate income is by selling those assets gradually, well, that's not a very efficient way of generating income. And so it's anyone's guess as to how long that nest egg is going to last. So if you're building a nest egg, That's great. Maybe you should also look into building up a safe pool of capital, like you said, and then also trying to find ways to increase your income and reduce your expenses, which doesn't necessarily mean compromising your lifestyle. It just means getting more efficient. So everything I do is about helping my clients realize more cash flow efficiency. Whatever your income is, whatever your expenses are, let's be more efficient in how we manage that, right? We can optimize your insurance policies. We can optimize your infinite banking system. All these things we can do so that over the long run, you create more cash flow. And ultimately, the asset you need to invest in the most is the one you see in the mirror,
Yeah.
because that's the one that's going to get you financial freedom. Because whole life insurance is great. It's not going to make you financially free by itself. It will help you get there quicker, more safely, and with more control and guarantees and protection, but it's not going to make you wealthy. Glenn Yaney will not become financially free because of his whole life insurance policies. He'll become financially free because of his mobile home investing. And whole life insurance helps him to get there quicker with more safety, liquidity, access, and control.
When you have tier one capital, which you are tier one, and you have to invest in yourself. And if you don't put money into yourself, it's like that income you hear it all the time. The same person that's making $50,000 is the same person that ends up making $1 million a year. If they lost everything today, they would be able to do it again because they know how to get to $1 million. If you put it into a 401k, it doesn't align with my incentives. And I don't know where that money's going. And if we want to talk about fees, it's not even the fees that, say, Vanguard would be charging. It's the fees that you're giving somebody and the company is charging you to manage your money inside their company. There's fees inside of it. There's employees. There's all these things happening. The more direct I am with my capital, less likely there will be fees and also an understanding what is happening. Like when I put my dollars into paying off a debt, I already know what my return's going to be. You
Right.
brought up Warren Buffett. It was, you said that he holds cash and he could probably get it if he put it into the market. He knows that. But in reality, he only makes calculated investments. When he bought Occidental, he knew this was going to be a home run. They call it elephant hunting. They're looking for the big deals and guaranteed. They know the upside there. They're buying full stock because they knew that people can't put down their phone. It's like the number one sold phone, or maybe Samsung. They looked at the numbers and it was the first like tech stock he bought. When he was anti-tech, he looked at the numbers and he's like, okay, maybe this is a good idea. And it's one of his biggest holdings now. And so just like
Yeah. And,
that,
and to
uh,
your point about the understanding, invest in what you know. Invest in
yes.
what you know. The vast majority of people have no clue how the S&P 500 works, right? Because it's not enough to just understand the company that you're buying. Because when you buy it and you're going into the market, the way in which you're participating is through what we euphemistically call the stock market. And that's a whole nother animal too.
Yeah.
Like if I own a company directly, then I just need to understand that company. If I buy a stock, I'm not just buying that company, I'm also putting myself in a vehicle that Wall Street controls. They control the way that whole thing works. That's why we can oftentimes see company does very well, but their stock doesn't do well. Company's a joke, but their stock does great. That can happen. You're not really buying companies directly. So the mode of participation matters quite a bit. If Microsoft does well, the CEO of Microsoft benefits quite a lot. Your
Yeah.
average stockholder might not benefit at all. They're much more removed, much more indirectly. You directly buy real estate, so you benefit quite a lot. If I buy REIT, real estate investment trust, or I buy some stock of a company that invests in real estate, my participation is very indirect. And so I don't really benefit all that much from it. So the vast majority of people are putting their money mindlessly, sometimes without even knowing they're doing it, into mutual funds, into 401ks and retirement accounts, which they don't understand in the slightest. So I would not recommend putting your money into something that you don't understand. There's nothing wrong with just saving your money, right? A 401k is not a savings vehicle, it's investing. And if you don't understand the investment and you have no control over the outcome, I would say you're setting yourself up for trouble. It really doesn't matter what the investment is. If you don't understand it and you have no control over the outcome, I would recommend just saving your money. You don't have to invest. You don't have to take on risk. Saving your money in a guaranteed vehicle like whole life insurance until you feel educated enough and comfortable enough and passionate about something where you feel like that's worth investing in. And usually it's going to be you starting a business. That's usually the best investment you can make. So my recommendation to everyone who's truly seeking financial independence, my number one piece of advice would be start a business, which is not as hard as you might think. You don't have to quit your W 2. You can think of some hobby that you have, some skills that you have, and start it on the side. And you'll start learning. Your mindset will start changing. You'll start acquiring new skills. You'll get another stream of income. That's how most people who reach financial independence, very few of them got it from speculating in the market. Usually they got it by starting a business. That's how they reached financial independence.
Definitely. That was my turning point with 401k. I found people that were financially successful, and I found out they had no money in the stock markets. Oh, not one had money, and they were making hundreds of thousands. One was making over $1 million a year. Another one was probably in the same boat. The other guy was making about 20 to 30,000. He was the guy that I really followed at the beginning because he was a close friend of mine. And I would talk to him about stocks, and he didn't want to hear anything about it because what he was doing was investing in himself and buying real estate. But it doesn't have to be real estate. If I looked at how much money I pay in interest and I just figure out how to not pay interest, I will have a lot of income over time. Just
Yep.
figure out a way not to pay interest, and I recapture it through my policy. The reserve funds will grow over time, and then eventually I'll be on the other side where I'm giving loans to people, whether it's through equity, whether it's through real loans, or if I'm giving myself a loan to go out and start this career that I'd like to start, whatever it is.
Yeah, absolutely. Glenn, we thank you so much for your time. This has been a great, wide ranging conversation, somewhat meandering, but I think we hit on a lot of really important points. Anything you want to leave our audience with in closing?
Oh, just have a podcast. It's the Millionaire Journey podcast. We talk a lot about real estate, and I try to be as honest as I can on it to let other people hear what it's like.
Yep, we'll link to that below. You should definitely check out his podcast if you want to learn about real estate. He also talks some about infinite banking and velocity banking. I've been on his show a couple of times. Glenn, thanks so much for your time. We look forward to the next one.
Thank you.
All right, bye bye.